It looks like waste. To the untrained eye, it's just a graveyard of industrial history, rusting steel, copper wiring, and discarded components. It feels like a leftover, a nuisance to be cleared away so the real work can continue. And because it is labeled as waste, no one is watching closely. But in the shadows of these iron mountains, a silent theft is occurring. What if I told you that this pile of junk was actually worth millions? Welcome to the world of scrap sale leakage, where corporate fortunes vanish into thin air, one truckload at a time. This is not just about trash, it's about a sophisticated breakdown of trust and control. Today, we peel back the layers of the most ignored asset in the corporate world. In many large-scale organizations, the manufacturing floor is the star of the show. Millions are spent on production efficiency, quality control, and logistics. But at the end of the line, the story changes. Scrap is treated as a byproduct, a secondary thought. It's unglamorous, it's dirty, and in the eyes of management, it's often valueless. But here is the danger. What is ignored often becomes invisible. When an asset loses its perceived value, it loses its protection. Across the global corporate landscape, billions of dollars in material value are funneled into these bins every day. When the oversight stops, the leakage begins. It's a psychological blind spot that fraudsters have learned to exploit with clinical precision. If you don't value it, someone else will. Because scrap is not waste. Not in the real world of global commodities. It is value waiting to be realized. Think about the high-grade copper used in electrical systems, the rare earth metals in discarded electronics, or the specialized alloys from aerospace components. These are not just scraps. They are liquid assets. In a fluctuating global market, the price of these materials can skyrocket overnight. For a savvy operator, an unmonitored scrap pile isn't a mess. It's a gold mine. It represents raw material that has already been paid for by the company, now sitting in a gray area of the balance sheet. To understand the fraud, we must first change our perspective. We aren't looking at a junkyard. We are looking at a vault with the door left wide open. The opportunity is there, and as we are about to see, the execution is simpler than you think. The foundation of any fraud is a weakness in the system. Scrap processes are notorious for being the weakest link in the corporate chain. They are often poorly monitored, rarely audited, and managed by individuals who have little incentive to optimize the recovery value. In many cases, the entire process relies on manual records, handwritten slips that can be easily altered or lost. The technology used is frequently outdated, disconnected from the company's main ERP system. Supervision is loose. The person responsible for generating the scrap is often the same person responsible for its disposal. This lack of segregation of duties is a red flag in any other department. Yet in the scrapyard, it's standard practice. This isn't just a failure of process. It's an invitation for manipulation. When the gate is open and the books are messy, the temptation becomes irresistible. The first stage of the heist is quantity manipulation. This is where the physical reality of the scrap is separated from the digital record. It happens at the weighbridge, the gatekeeper of the yard. Through various techniques, actual quantities are reduced before they are ever recorded in the system. Perhaps the truck is partially weighed, or the scale is tampered with to show a lower reading. Sometimes it's even simpler. A portion of the high-value scrap is accidentally labeled as low-value waste. If a truck carries 10 tons but the records only show 7, 3 tons of pure profit have just been created for the conspirators. These missing tons never existed on paper, making them impossible to track through traditional audits. It is a ghost inventory, moving through the system in broad daylight, invisible to the accountants in the head office. The leakage has begun, and the numbers are already starting to bleed. If you can't hide the quantity, you hide the price. Underpricing is a more subtle, yet equally devastating form of leakage. It involves selling high-quality scrap at significantly reduced rates, often under the guise of market fluctuations or low-grade quality. Invoices are generated showing rates that are 20, 30, or even 50% below the actual market value of the material. This happens quietly, repeatedly, and usually with the same preferred buyers. To an outside observer, it looks like a legitimate sale, but the reality is a massive transfer of wealth from the company to the buyer, and whoever is being bribed on the inside. Because there is rarely a competitive bidding process for scrap, these low prices are never challenged. The company takes the loss, the buyer gets a bargain, and the conspirators take their cut. It's a win-win for everyone, except the shareholders. Fraud of this scale rarely happens in isolation. It requires a bridge between the inside and the outside. This is where collusion enters the frame. Internal employees, often those in positions of trust within the warehouse or procurement, work in tandem with external scrap buyers. It's a partnership built on mutual greed. The employee ensures the system stays weak, the quantities stay low, and the prices stay suppressed. In return, the buyer provides the kickbacks, untouchable cash that never touches a bank account. This isn't just a one-time bribe, it's an ongoing business relationship. They meet in parking lots, communicate through encrypted apps, and share the spoils of a system they both know is broken. In the world of corporate investigation, collusion is the most difficult knot to untie, because the people responsible for the controls are the ones bypassing them. Sometimes, the most effective theft is the one that simply walks out the front door. Silent diversion is the practice of loading extra, unrecorded material onto a truck that has already been cleared. It's the 3-for-2 deal that the company never authorized. A truck is weighed for 5 tons, but as it heads for the exit, another 3 tons are added in a blind spot of the yard. The paperwork remains the same, the driver has the necessary signatures, and the security at the gate is either incompetent or part of the scheme. The truck leaves the facility with thousands of dollars in free material. This additional scrap is never recorded, never invoiced, and simply ceases to exist in the company's records. It is the ultimate vanishing act, executed with the precision of a stage magician, but with consequences that are very, very real. Individually, these transactions might seem small, a few $100s here, a few thousand there. In a billion-dollar company, it looks like a rounding error. But fraud is a game of accumulation. Over weeks, months, and years, these small leaks join together into a massive torrent of revenue loss. By the time anyone notices a discrepancy, the loss has already become systemic. For a mid-sized industrial firm, the impact can be staggering. We are talking about millions of dollars in pure profit wiped off the books, money that could have been used for expansion, for research, or for employee bonuses. Instead, it is lining the pockets of a few corrupt individuals. This is the true cost of the ignored asset. It's not just about the metal, it's about the erosion of the company's financial health, one hidden truckload at a time. The numbers don't lie, but they can be very good at hiding. The most dangerous aspect of scrap leakage is that it rarely triggers an alarm. In the boardroom, the focus is on top-line revenue, market share, and operational efficiency. Because scrap is labeled as waste, it sits outside the primary area of scrutiny. No one questions why the scrap revenue is lower than expected because no one knows what it should be. Management remains blissfully unaware, celebrating quarterly successes while a $3 million hole is being bored into their bottom line. There are no missing laptops, no suspicious bank transfers, and no obvious red flags in the main accounts. The fraud is perfectly camouflaged within the normal operations of the factory. It's a silent predator, thriving in the gap between what management sees and what is actually happening on the ground. By the time the suspicion finally arrives, it's often too late. Why does this happen? It's a matter of priority. In the high-pressure world of manufacturing, production is king. Every minute of downtime is tracked, every defect is analyzed, and every employee is measured. But the scrapyard? It's the back of the house. It's where the failed parts go to die. It doesn't get the best lighting, the best cameras, or the best people. It escapes the gaze of the internal auditors because they are too busy looking at the high-value inventory in the main warehouse. This hierarchy of assets is exactly what the fraudster relies on. They know that if they steal a finished product, they'll be caught in hours. But if they steal the scrap from that same product, they can do it for years. As long as management views scrap as a low-priority nuisance, it will remain a high-priority target for fraud. The final barrier to detection is a lack of transparency. In a healthy organization, every input is reconciled with an output. If you use a ton of steel and produce 900 kilos of product, you should have 100 kilos of scrap. It's simple math. But in many companies, these two departments don't speak to each other. The production team reports the waste, but no one checks if that waste ever reaches the scrapyard. The scrap team reports the sales, but no one checks if those sales match the production waste. Without this cross-verification, the leakage remains hidden in the shadows of the silos. It is a failure of communication that is worth millions. When the right hand doesn't know what the left hand is doing, or what it's selling, the company becomes a playground for collusion. Transparency is the light that stops the rot, but in the scrapyard, it's often pitch black. But even the most perfect crime leaves a trail. There are warning signals, red flags, that a vigilant organization can spot. Look for unusual price variations that don't match the global commodity markets. Watch for the preferred buyer syndrome, where the same small group of buyers wins every bid, year after year. Pay attention to the mismatch between what your machines are discarding and what your yard is selling. These are the cracks in the facade. When a supervisor is overly protective of the scrapyard, or when a security guard refuses to let anyone else check the weighbridge, the alarm should be sounding. These signals are the fingerprints of collusion. They are the clues that tell the story of a system being bled dry from the inside. Ignoring them isn't just bad management, it's an expensive mistake. The signs are there. The question is, are you looking? The lesson here is powerful, and it applies to every corner of corporate life. What is ignored becomes vulnerable. The solution isn't just about more cameras or bigger locks. It's about a fundamental shift in mindset. It's about recognizing that every byproduct of your operation has value, and that value deserves protection. Implementing digital tracking, ensuring segregation of duties, and conducting regular, independent scrap audits can turn a leakage risk into a revenue stream. Internal audit should be seen as a source of protection, not policing. It is about providing the assurance that the company's hard-earned assets, in whatever form they take, are being handled with integrity. When you shine a light on the scrapyard, the shadows of fraud disappear. This is the future of corporate governance, where nothing is too small to matter and no asset is too dirty to be clean. As our industrial operations grow more complex, as supply chains stretch across continents, the opportunities for fraud only increase. The scrapyard of the future will be even larger, more diverse, and more valuable. But without a change in how we view these leftovers, they will remain a silent goldmine for those willing to exploit them. The leakage of today could become the catastrophe of tomorrow. Don't wait for the millions to vanish before you start watching the waste. Because in the corporate world, what you don't see is exactly what will cost you the most. The story of scrap sale leakage is a reminder that in business, there is no such thing as trash, only assets that haven't been counted yet. Are your eyes open? Or are you still just looking at the waste? If this video opened your eyes, like, share, comment your thoughts, and subscribe to Corporate Secrets